Hey everybody, Dr. Phil here. So this is a video on making capital investment decisions. So relevant cash flows are what we call in finance the standalone principle. So relevant cash flow for a project is a change in the firm's overall future cash flow that comes out as a direct consequence of the decision to take that project. So incremental cash flows are the difference between a firm's future cash flows with a project and then those, just imagine the project didn't exist. Any cash flow that exists regardless of whether or not a project is undertaken is not relevant because it doesn't change based on the decision you're making, right? Take the project, don't take the project. Now, the standalone principle is the assumption that evaluation of a project may be based on the project's incremental cash flows. Once we've figured out the incremental cash flows from undertaking a project, we can view that project as a kind of like mini firm with its own future revenues and expenses, its own assets, and its own cash flows. So we're primarily interested in comparing the cash flows from this mini firm, if you will, to the cost of acquiring it. So let's just define a couple of terms. A sunk cost, think about like the old expression, water under the bridge. A sunk cost has already been incurred and cannot be removed, and therefore should not be considered in an investment decision. An opportunity cost is the most valuable alternative that is given up if a particular investment is undertaken. So think of like the next best use of the money. Now recall that incremental cash flows for a project include all resulting changes in the firm's future cash flows. It's not unusual for a project to have a side or a spillover effect, which could be good or bad, positive or negative. Erosion occurs when the cash flows of a new project come at the expense of a firm's existing project. So that's not always good. Projects normally require the firm to invest in net working capital in addition to long-term assets. So the project's going to need some kind of cash on hand to pay any expenses that arise, as well as initial investment in inventories and accounts receivable. So the investment in the project net working capital, in that sense, kind of resembles a loan in the sense like you sunk all your money into this project, and now you're trying to get that money back. Financing costs. In analyzing a proposed investment, we don't include the interest paid or any other financing costs. So things like repayment of principal on a loan, dividends, because we're interested in the cash flow generated by the assets of the project. The goal in this type of evaluation is to compare the cash flow from a project to the cost of acquiring that project in order to estimate the net present value, the NPV. We're only interested in measuring cash flow at the time when it actually occurs, not when it accrues in an accounting sense. Okay. We're also interested in after-tax cash flows because taxes are definitely a cash outflow. So we're kind of saying, okay, what's the cash coming in after we've paid tax? Okay, so let's talk about pro forma. So pro forma financial statements project future years' operations. So whenever you think about the word pro forma, typically means this is a forecast, this is a guess. So as an example, suppose we think we can sell 50,000 cans of shark attractant per year at a price of $4 a can. It costs about $2.50 per can to make the attractants, and a new product such as this one typically has a 3-year life. We require a 20% return on new products, as would typically be set by our investors and board of directors. Fixed costs for the project, including such things as rent on the facility, will run $17,430 per year. We will need to invest a total of $90,000 in manufacturing equipment and assume the $90,000 will be 100% depreciated over the 3-year life of the project. The cost of removing equipment will roughly equal its actual value in 3 years, so it'll be essentially worthless on a market value basis at the end of that period. The project will require an initial $20,000 investment in net working capital, and the tax rate for the company is 21%. So this is kind of how we could set this up. So we've got our projected, or you could say pro forma income statement. Sales, 200 grand, 50,000 units times $4 a unit. The variable cost, $2.50. So 50,000, that's 125 grand. Fixed cost, 17,430. Depreciation, 90,000 divided by 3, so 30,000. And then that's EBIT is earnings before interest and taxes, 27,570. Take out 21% of tax. And then our net income is 21,780. And then what I'm showing you down here is just these are kind of the capital requirements for the project, right? So think of like year 0 as like today, like now, and then we've got years 1, 2, and 3. So to develop the cash flows from a project, recall that cash flow from assets there's really three components, right? Operating cash flow, capital spending, and changes in net working capital. So once we have estimates of the components of cash flow, we can calculate the cash flow for we're going to keep using the term mini firm. So the project cash flow equals the project operating cash flow, subtract the project change in net working capital, subtract the project capital spending. That's going to give us our operating cash flow, which on the previous slide they call that EBIT, earnings before interest and taxes. Those terms are synonymous. And then we're going to add back any depreciation. We're going to subtract any taxes. So here you can see the projected income statement on the left and the operating cash flow on the right. So we just did this one. We had net income of 21,780. However, if we look at the cash flow, we've got the earnings for interest and taxes, 27,570. We're adding back in the depreciation because that's 30 grand of expense, but we're not actually having to spend that. And then we subtracted the taxes. So the operating cash flow is actually 51,780, mostly generated by the fact that depreciation is a non-cash expense. If you look at the bottom here, you can see, okay, yeah, we've got the negative 20 in year 0. We've got the capital spending negative 90. And then you can see where in years 1, 2, and 3, you can see how that money is being made back. So the NPV, net present value at the 20% required return is, so we're going to take out the 110 initial spend, plus the 51,780. So what we're doing here is you can see the 51,783 times to the power just of 1 basically, right? And then the power of 2, power of 3. The 20% is the tax rate, 1.2. And then we get, 20% is the rate of return. And we get net present value of 10,648. So based on these projections, the project creates over 10 grand in value and thus should be accepted. The return on this investment obviously exceeds 20%. We know that because the NPV is positive at 20%. If it was like right at 20%, the NPV would be 0. So if it's a negative number, it means it's less than 20%, right? If it's a positive number, it means the NPV is higher than 20%. So after trial and error, the IRR works out to be about 25.8%. So pretty good, pretty healthy. Payback on this project is about 2.1 years. The AAR is average net income divided by average book value. So net income each year is 21,780, and the average of the 4 book values and it works out to be 65. So if we just divide the 21,780 by the 65,000, we get 0.335. So we're basically saying the accounting rate of return, the accounting average return is 33.51 cents. So suppose that during a particular year of a project, we have the following simplified income statement. So we got sales of 500, costs of 310, net income of 190. So depreciation and taxes are 0. There's no fixed assets that they bought during the year. And we assume the only components of NWC net working capital are accounts receivable and payable. So beginning and ending amounts for these accounts are as follows. So you can see how we got accounts receivable, we got accounts payable. One subtracted the other gives you the net, like 880 minus the 550 is going to give you that 330. And then we're just looking at the beginning of the year versus the end, how those amounts changed. So it kind of gives you an idea of your liquidity, if you will. So what is total cash flow for the year? So operating cash flow in this sense is the same as EBIT because simply there are no taxes or depreciation, so it's the 190, right? The net working capital actually declined by 25, which means that 25 bucks was freed up during the year. There was no capital spending, so the total cash flow for the year is the total cash flow. Obviously, we know this from the previous formula. Operating cash flow minus the change in net working capital minus the capital spending. So the 190 minus the negative 25, which obviously 2 negatives make a plus, minus 0. So we have total cash flow of 215. So the 215 total cash flow must be in dollars in less dollars out for the year. So we could therefore ask a different question. What were cash revenues for the year? And also what were cash costs? So during the year, we had sales of 500, but accounts receivable rose by 30. So cash inflow, apparently they just paid straight away. So we have a cash increase of the 470, right? The costs during the year were 310, but AP, accounts payable, increased by 55. So cash costs for the period that they actually paid out were 255. So we calculate the cash inflows less the cash outflows are 470 minus the 255, which is the 215. That number should sound familiar to you because that's the number we had before. And then if you want to pause this for a second, you can just take a minute and go over these. Just think about this is how we're getting all our changes in operating cash flow and the change in net working capital. All right, so there are different definitions of project operating cash flow that are commonly used, both in practice and also in finance texts. Keep in mind that when we speak of cash flow, we literally mean dollars in, less dollars out. So we're talking about the difference, right? For a particular project and year under consideration, suppose we have the following estimates. So we have 1,500 bucks of sales, we have costs of 700, we have depreciation of 600. With these estimates, notice that EBIT, which is sales minus cost minus depreciation, is 1,500, minus the 700 in costs, minus the 600 in depreciation is 200. Assume no interest is paid, and the corporate tax rate is 21%. So the tax bill is, the taxes is going to be the EBIT times the tax rate, so 200 times 0.21. So we would owe $42 in tax based on a 21% rate on that 200 of EBIT. Now the project operating cash flow, the OCF, is we calculate that as EBIT plus depreciation minus taxes. So plug in your 200, plug in your 600 off depreciation, and then subtract your taxes, and we get the 750, 758. Now, with the bottom-up approach, we actually begin with the accountant's bottom line, which is net income, and we just add back any of the non-cash deductions, so things like depreciation. Now, it's important to remember this definition of operating cash flow is correct only if there is no interest expense subtracted in the calculation of net income. If there is, this method does not work. You don't need to use it. Because we are ignoring any financing expenses, such as interest, in our calculations of project OCF, we can write project net income as, so we just plug in your numbers, right? 200 is the net income, and then subtract the taxes, 42, and then we get, of course, we get the 158. If we add the depreciation to both sides, we get a slightly different and very common expression for operating cash flow, which is just net income plus depreciation, so the 158 plus the 600, and of course we get the 758. Now in the top-down approach, we start at the top of the income statement with sales, and we work our way down to net cash flow by subtracting costs, taxes, and expenses. This is the more common way, by the way. Leave out any strictly non-cash expenses, so things like depreciation, for example. So in this top-down approach to OCF, operating cash flow, sales 1,500 minus the cost of 700 minus the taxes of 42 gives us 758 for OCF. Now the tax shield approach views OCS as having two components. So what's the project's cash flow? What would that be if there were no depreciation expense? Would have been 632. And then the depreciation multiplied by the tax rate. So if we take the 600 depreciation deduction, the reason it's called a tax shield is because it saves us 600 bucks. If we times that by 0.21, it saves us 126 in taxes. So the tax shield definition of OCF is just OCF equals sales minus costs times 1 minus, that's TC, just the tax rate, plus the depreciation times the tax rate. So if we assume the tax rate, again, is 21%, just like it was before, the OCF works out to be, so 1,500, right, minus the 700 times 0.79 plus the 600. The 0.79, by the way, look up here, that's 1 minus the tax rate, so I think like 1.0 minus 0.21. And then plus the depreciation 600 times the tax rate 0.21. So we get 758. So it's kind of like a lot of different ways of doing the same thing. All right, evaluating cost-cutting proposals. Suppose we are considering automating some part of an existing production process. The necessary equipment costs 80 grand to buy and install. The automation will save 22 grand a year before taxes by reducing labor and material costs. Assume the equipment has a 5-year life and is depreciated to zero on a straight line basis over that period. It will actually be worth 20,000 in 5 years. So the question is, should we automate? The tax rate is 21% and the discount rate is 10%. So identify the relevant incremental cash flows. So the initial cost is 80 grand and the after-tax salvage value is 20,000 times 1 minus 0.21. That's of course the tax rate, which equals 15,800. And remember, the book value will be zero in 5 years. There are no consequences to working capital, so we're good there. Now we're going to examine the operating cash flows. So buying new equipment affects operating cash flows in two ways. One, we save 22,000 before taxes every year. And two, we have an additional depreciation deduction. In this case, the depreciation is 80,000 divided by 5, because it's a 5-year project, which is going to give us 16,000 per year. So think about that tax shield, if you will. So because the project has op income of 22 grand and depreciation deduction of 16, Taking the project will increase EBIT by the difference between the two numbers, which of course is 6,000. Because EBIT is rising for the firm, taxes will increase. So increasing taxes will be 6,000 times the 21% tax rate, 0.21. So taxes will go up by 1,260. We can now compute operating cash flow in the usual way. So we take our EBIT like we did before, add back in the depreciation, minus the taxes, and we get operating cash flow of 2,740. Now we could also use a different approach. We could take the 22 times 1 minus 0.21, which is just going to give us basically the income after taxes, 17,380. We have an extra 16,000 in depreciation, which isn't a cash outflow, but it does reduce our taxes by 21% of that 16 grand, so 3,360. Then we just take those two numbers, add them together, and we get the 20,740. So here you can see the relevant cash flows. So you can see where in year 0, again, just today, we spent 80 grand, and then you can see where the money is coming back in, and then you can see kind of how we end up in year 5. So at 10%, it's straightforward to verify that the NPV here is 8431. So the answer is it's a positive number, right? Positive 8431. So we should go ahead and automate because we are surpassing our hurdle rate. All right, so to buy or not to buy sounds very philosophical here. We are considering the purchase of a 200,000 computer-based inventory management system. It will be depreciated straight line to 0 over its 4-year life. It'll be worth 30 grand at the end of that time. The system will save us 60 grand before taxes in inventory-related costs. The relevant tax rate is 21%. Because the new setup is more efficient than our existing one, we will be able to carry less total inventory and thus free up 45,000 in net working capital. So the question is, what is the NPV at 16%? What is the discounted cash flow return, basically the IRR on this investment? So we can first calculate the operating cash flow. The after-tax cost savings are 60 grand times, again, 21% tax rate, so 1 minus 0.21, which is 47.4. The depreciation is 200,000 divided by 4-year useful life, so 50,000 a year. So the depreciation tax shield per year is 50,000 times 0.21, so 10,500. Operating cash flow is 47,400 plus the 10.5, so the answer is 57,900 per year. Now the capital spending involves 200,000 upfront to buy the system. So we have to spend that 200,000 today, like year 0, right? You can see it here, negative 200. The after-tax salvage is 30,000, but that's again a tax break. So factor in the tax, it works out to be 23.7. Finally, and this is the somewhat tricky part, the initial investment in net working capital is a 45,000 inflow because the system actually frees up working capital. So take a minute to think about that. Furthermore, we will have to put this back in at the end of the project's life. What this really means is simple. While the system's in operation, we have 45,000 to use elsewhere. Okay, and then you can see in year 0 all the way through year 4, you can see in year 1, 2, and 3 the cash flows are the same, and then of course in year 4 we got the 45,000 that we have to now basically take back in. So 16%, the net present value is minus 4,749, so the investment is not attractive. After some trial and error, we find that the NPV is 0 when the discount rate is 14.36%. So it turns out the IRR on this investment works out to about 14.4%. So most likely, as the NPV is negative, we would not proceed with this project. All right, so let's talk about setting the bid price, and let's look at an example. If a competitive bid must be submitted to win a job, the winner is whoever submits the lowest bid, obviously. So imagine we're in the business of buying stripped-down truck platforms and then modifying them to customer specs for resale. A local distributor has requested bids for 5 specially modified trucks each year for the next 4 years for a total of 20 trucks in all. We need to decide what price per truck to bid. So we can buy the truck platforms for 10 grand each. We can lease the facilities for 24,000 a year. Labor and material cost is about 4,000 per truck. The total cost per year is 24,000 times plus 5, times the 10,000 plus 4,000 from here and here. So we have 94,000 total cost per year. So what price per truck should we bid if we require a 20% return? So we're going to need to invest 60 grand in new equipment, which will be depreciated straight line to a 0 salvage value over the next 4 years. It'll be worth about 5,000 at the end of that time. We're also going to need to invest 40,000 in raw materials and other working capital items. We have a relevant tax rate of 21%. So the capital spending and net working capital investment, as we said, we got to spend 60 grand today for the new equipment. And the after-tax salvage value is 5,000 times 1 minus 0.21. So it's actually after tax, it's 39.50. We need to invest 40,000 today in net working capital, which you can see here. Change in net working capital, negative 40. There's our capital spend of 60 in year one. And then we have 1, 2, 3 years of operating cash flows. We've also got year 4. And then where the 40,000 is going to come back. And we're going to be up 39.50 for what we are able to sell the equipment for after tax. The lowest price we can profitably charge will yield a zero NPV at 20%. So determine what operating cash flow must be for the NPV to equal 0 by calculating the present value of 43,950 non-operating cash flow from the last year. Think about this right here, the 43,950 in year 4, and subtracting it from the 100,000 initial investment. So that's what I'm doing here, right? 100,000 initial investment minus the 43,950 over 1.20 to the power of 4 because it's a 4-year project equals 100,000 minus 21,195, and we get 78,805. So operating cash flow is now an unknown ordinary annuity amount. So the 4-year annuity factor, look at your tables, 20% is 2.58873. So we have the NPV equals 0, which equals negative 78,805, plus the operating cash flow times the annuity factor. So we're just basically trying to solve for the operating cash flow, right? So you rearrange the equation, and we get that the operating cash flow needs to be 30,442 each year. So the final problem is to find out what sales price results in an operating cash flow of 3442. Now remember, the operating cash flow can be written as net income plus depreciation, the idea of like starting at the bottom and working your way up. So depreciation here, as we know, is 60,000 over 4. That's 15,000 a year. So given this, we can determine that net income must be operating cash flow, net income plus depreciation. So 30,442 equals net income, and then add the 15. So thus we know the net income is 15,442. So if it's 15,442, then our income statement, as we kind of bottom up, we got the 15,442 here. We can solve for sales by noting that 15,442 equals the sales amount minus the 94 minus the 15 times 1 minus 0.21 to factor in taxes. So if we simplify for that, we get a sales amount of 128,546. And because the contract calls for 5 trucks a year, the sales price has to be the 128,546 divided by 5, which is 25,709 per truck. All right, thanks for watching the video, and I will see you all in another video very soon.